I wanted to jump into we talked about this yesterday, but the section 174 stuff, because I think it's also relevant to
People
this
are going to be
whole like,
so glad that they stayed tuned for the tax update.
I mean,
They're
that
going
might
to
be
be like, "Wow,
that
I'm
might,
The
glad I
sizzle
listened.
reel.
I listened.
Let's
It like
go.
let's go."
One characteristic emerged as a significant predictor of success. It was grit.
all right, cool. Yeah, we don't have the fancy intros like some of these
Yeah.
podcasts. We just roll with it and jump in there and fix
Well,
it
we're going to
later
talk
if it's
about
terrible.
big band software. So if you want to go big and splice in some, some
Oh,
big
yeah.
sounds, like
Like
if there's ever an
explosions.
episode where it
I
might
love it.
work.
This
Yeah,
is it.
that's a good call.
Well, yeah, maybe that's a good starting point. So we've got Chris Reedy on the podcast, and yeah, why don't you? I know you guys have been launching your new business, and I would not do it justice. So I'd love to just hear you kind of quickly talk about what you guys do.
Awesome. Thanks, Landon. Good to see you again, and Kyle too. Thanks for having me on. So Chris Reedy, I lead acquisitions, and I'm one of the co-founders at a new SaaS holding company called Big Band Software. So, the big idea is that they're still great, but smaller businesses, particularly B2B SaaS, that the founders might need a different exit. They might want a different exit than is available from a strategic buyer, an individual buyer, or private equity. So Big Band is a holding company. We run a long-term profitable growth model for the businesses we buy. We are fully funded, which is it feels really good to say right now. And so we're an option out there, getting ready to sort of add businesses to the portfolio. Great B2B SaaS businesses. Often they're going to be bootstrapped or lightly funded, not always, but we're buying 1 to 6 million ARR today is our kind of sweet spot. And the other co-founders, Jason Heath, who spent time at WebPT, Lead Pages, Drip, and GoDaddy. He's our co-founder and COO and CFO, and also Kevin McCardle, who I worked with back at SureSwift Capital. And Kevin's our CEO.
We've met because we kind of know, we've all been in this sort of bootstrapped SaaS kind of world for a while. I thought it would be interesting to bring you on. Obviously, I'm interested to know more about what you guys are doing now. I think a lot of SaaS founders and entrepreneurs are also interested in what you guys are doing and what other companies are kind of doing in this space. Because eventually, I would say most of us probably want to exit at some point. Maybe not. Maybe you just keep the business and just roll out the profits over time. But so I wanted to have you on to kind of talk about what you guys are doing, but also just learn from you in terms of things like how we can best prepare for an exit in the future, what kind of things you're seeing in the market, and maybe that's a good kind of thing to jump into. What are you seeing in the market? Obviously this is a completely different time now in terms of just the overall macroeconomic situation. I think it's tough for a lot of SaaS companies right now. Probably even tougher for companies that raised, a decent amount of money because their valuations have dropped. So I'd imagine there's probably a lot of companies on the market right now or will be over the next 6 to 12 months. So is that kind of what you're seeing in the market right now? I mean, what are you experiencing?
Yeah, I guess a little bit surprisingly, that's not what we're seeing, and it's not what we're hearing from other folks that we talk to. I think particularly at the larger end of our buying range, and we can stretch to buy a little bit bigger companies, but at the larger end in particular, kind of the word on the street with advisors, bankers, brokers, it's really slow. Like a lot of folks, if they weren't running a process in 2022, they're not kind of coming out of the gates in early 23 feeling like that it's the right time to sell, particularly for bigger businesses that maybe they've gotten some funding. It's not just the founder making that decision; it's the full board. And I think part of that's timing, but part of that is is just it's kind of hard to make a decision when suddenly there are more moving parts than everybody's used to, right? So it's not as if there aren't great companies that we're talking to. It's not as if there aren't great companies that have decided it's the right time to sell. But overall, I'd say early 23, whether it's through some of the acquisition platforms that you all may go on and sort of check out, like acquire.com or other places like that, or whether it's direct or through bankers, it's a little slower than I would have guessed. Doesn't seem like it's going to last forever, but I think there's a little bit of it's a lot of it's really hard to process the amount of change going on in the market, and and frankly, it's also harder to run a sale process while you're also trying to get to more customers and provide more value to those customers, right? It's not easy to do both.
I mean, Kyle and I can attest to that, where it's like we've obviously sold one smaller SaaS company and gone through the process a few times, and it's very difficult to obviously that's important, so you're focusing on that and you're trying to do the thing. You may get requests from buyers about what what they need or whatever, but you're trying to juggle that with just like the day-to-day of like keeping things running and making sure you don't have churn and getting customers on board and all this kind of stuff. So it's very difficult to kind of juggle all of that at the same time, especially when you don't have like a big team or like a broker or somebody that's like helping you do that, which a lot of us don't.
Yeah, it's a tough juggle for sure.
I was going to say, you mentioned like that's sort of what you're seeing at the higher end, which I can see. I was curious if what is it? Does it look similar at the lower end of your kind of like target range, or does that area feel like? I feel like in some ways that the bootstrapped ecosystem, setting aside the tax implications that I think we'll hit on later, the new tax stuff, if you have like a profitable business, it's like never been more attractive in the past decade than it has right now, probably. So in that way, it seems good. But are you seeing like kind of a similar, like, hey, let's just pull back and like pause and kind of focus on internal and the small end, or what does that look like?
I'm not as sure at the small end. There's still a lot of activity there. I think the sort of founder headspace of, is it really the right time to sell? I think that's definitely still there. One quick aside and caveat is something that I don't hear from a lot of founders that I would sure think about if I were a founder is like, well, yeah, maybe valuations had come down a little bit, but the reality is you're also, if it's a good acquisition, you're getting a big check to invest, right? And the reality is it's probably a pretty good time, going to be a better time, at least by the numbers, than a year ago to go put that check into a big public portfolio that's going to de-risk you for a long time. So the other thing I guess I would note about the smaller end, and this is just my take based off of absolutely no data or analysis, so throw it out the window if you want, but I do think at the smaller end, the awesome opportunities created by, like folks like Andrew Gazdecki at acquire.com and other developments for independent founders, like other ways to connect to buyers. I do think it kind of pulled supply forward a little bit. I think some businesses were sold in the last couple of years that, if it had been harder to access potential buyers, they wouldn't have been sold, right? And, at the extreme end, I think sometimes founders weren't sure if they wanted to sell, and they would sort of put the shingle out and see what the conversations looked like, which is sometimes not. Sometimes that's not going to be helpful. It's not that conversations are bad, but if you're actually saying you want to sell and you're not fully committed, it's hard to make the right transaction happen. But I do think in 21 and 22, some of the changes in the ecosystem, honestly, I think they pulled some of that supply forward. If you should, pulling back and not thinking about the people involved and its supply and demand, some of that supply, I think, hit the market in the last couple of years, and it's going to take a little while to stabilize a little bit. There's still some great businesses, and it's a big, big world of SaaS. So let's be honest, like it's not like not like my calendar isn't full of meetings with awesome founders thinking about selling, but overall, I think it's a little bit slower to start 23.
Yeah, especially that's a great point. I never thought about like at that low end, like the ability to sell your business that's like making, I don't know, 50K or 250K annual recurring, like that's a small business. Before those things like acquire, it's a lot harder to find buyers for that. So like those end up growing into maybe your low end, right? And instead they're getting sold early, which is kind of interesting to think about.
Yep. Yeah, and it's creating I think it is creating a different model for entrepreneurship, right? So you can, I mean, it's one thing to say you're a serial entrepreneur, but if serial entrepreneur means like you start something new every 5 to 10 years versus every 18 months to 2 years, that's a totally different kind of path that you're on. Both totally work, but it was really hard to make that shorter timeline work historically.
Yeah, that's cool. That's a good, it's interesting. It's always good to talk to people like on the scouting side too, because it's like we always are just thinking about it from looking outward. But it's cool to see or hear from you about like the kind of the market in general.
That's kind of a good segue into something that is, when we kind of went to the market with user feed years ago, we started to like the things that we thought were important weren't as important as we thought, and the things that we just didn't care about were actually important. So, and I think that goes across like actual company metrics. So the types of things you'd be seeing in like ProfitWell or ChartMogul or wherever you host your metrics. There's obviously important metrics there, but I think for buyers, most of the time, the first thing you're going to hear from someone is, can I see your P&L from the last, 24 months? So there's a lot of things in the P&L that I think are important. Maybe if you could like talk about some of those things that, maybe are obviously important, but some things that people may not know, or that you kind of like talk to founders and then you can tell that they have no idea that actually is important. And it's something that you really care about on your end.
Yeah. I mean, I think, I think, founders, honestly, like it feels like founders have a better handle on their data year over year. Like the tools are getting so good. That's what I'd lead with is like, it is getting easier because it's easier for founders to be in touch with a lot of what's happening with their customer base. But to the question of like, where do we have some questions that maybe sometimes people aren't ready for, or what might founders want to pay a little more attention to? The first thing I'd highlight, which isn't usually in the first information pull, to be honest with you, but it sort of shows up in other ways when we ask for information from a company. The first thing is qualitatively, how important is your product to your customer base, right? And there are ways to track that in terms of user engagement, and percentage of users who are using the product, daily, weekly, monthly. I think that is incredibly important for founders to be aware of, even long before they're looking to sell, because what can happen, if that engagement is not really high, eventually churn is going to bite you in the ankle, right? Something's going to change in your customer base or in the macro economy, and that churn is really going to tick up. So some of that is happening right now. We've seen a little bit of that in some churn numbers from businesses we've looked at. But the most extreme recent example was like March 2020, right? The world shuts down, and there were a number of businesses who, if you were selling to restaurants, like it was obvious that your churn was going to tick up, right? But there were a number of other businesses that just suddenly lost a lot of customers because the product wasn't deeply ingrained in the most important work for that customer. And that's when you find out, are you a nice to have or are you a must have? So, that's one thing I'd highlight. The other thing on the financials that I'd highlight is it's really important to show like the long-term profitability of the business. Like anytime you're going to sell the business, you say, oh, our margins are 35, 40%, whatever. If a year ago you were running break even, right? There's a question on whether that 35, 40%, like, can that still sustain future growth of the business? Or is it, you're kind of running the red right now and eventually things are going to overheat. or the customers are going to notice that the service quality or the product quality is not there. So I think keeping an eye on that. Not that there aren't going to be, for smaller businesses, some step functions, right? If you all, for ad reform, you suddenly decide it's the right thing to do to make two, great developer hires, right? Like, that's okay that profitability jumps around, but overall, I think in terms of profitability, putting a shine on profitability when it goes to sell, which profitability is more important right now than it was a year ago. I think any buyer's going to have questions on, well, is that really the long-term picture of this business?
Yeah, for sure. Obviously there's different buyers across like different stages of, or different sizes of a business or sale price. So like, for user feed, we were a much smaller software company. So, you can kind of, I'd say there's a lot more buyers there. These are like individual people or maybe a couple people that are partnering up, pulling some funds together, like personal funds. Maybe they're doing like an SBA loan or something like that. And then obviously there's kind of on the, your end of the spectrum where you guys have like you're buying companies in cash a lot of times. Like it's not an SBA loan type of situation. And obviously isn't just like a single person buying. It's more of like a PE type of situation. But there's a lot more. There's other PE firms too. They're larger and that sort of thing. But I've noticed with smaller SaaS companies, let's say like they're under $1 million in revenue. A lot of people are trying to use SBA loans to purchase those businesses. And once you get into that realm, they start to really like, they don't even go into like, what is the pool on the product? And like, they don't even care about the product. It's 100% P&L, like right. Nothing else matters. And they're going to look typically like 2 to 3 years, in the past. So you can't really like improve something really quickly for 6 months or 12 months. Like this has to be something you've sustained for like quite a bit of time. And I guess that's probably because the SBA is like, they're not even like really meant for software companies, right? Like all the things that they kind of, I don't know, like when people started using those, it was probably more for, buildings or like real estate or restaurants or like, small businesses like that. So I think it's not quite tailored for the typical SaaS, but that's what I've noticed in kind of like having some of those conversations that P&Ls probably matter a little bit more when SBA is involved.
Yeah, I think that's right. And and one of the thing I'd say, one of the thing that sometimes founders aren't thinking about is they sort of think about, you think about the deal room things. How do you have your product in order to hand off to somebody else? Is not easy, right? It's not easy to hand off any business. Like it's a lot of risk to hand off who's making decisions and how decisions are made to a totally new set of people. Like it's risky. But one thing that can be super helpful to find the right buyer and de-risk that for the next owner can also be the hiring that you do. I think sometimes, particularly with independent founders who are super talented themselves and wear a lot of hats, then sometimes the rest of their team is hired and it's sort of developed in narrower ranges for specific needs for the business. And I can just say it's hard to do, but boy, if you go in to sell your business and you actually have somebody in the business who you think could lead it, like they have that level of ambition, they've been developing, that is something that, speaking for us, for Big Band, that's music to our ears. Like we don't know that, but it takes some time to figure it out. But that is meaningful to how risky it would be for us to buy the business. That it seems possible that there really is a full-fledged new leader. And even on the small end, at the small end, some of the buyers are not themselves technical leaders, or sometimes not even software people. Like they've got more of the financial lens on the business. They're buying it as an income producing asset, which software is not an annuity, and I do try to put that into any conversation I can, because you do have to continue to provide more value. But the more your team, you've made space for your team to sort of develop, and it's clear they're on a path, that is one of the sort of untalked about things that can hugely influence the valuation for an exit.
I think it's probably valuable to like get somebody in place like that, regardless of whether you're selling. I mean, that's like the bonus is like, if you sell, you're more valuable to, or like people that are buying it would want that in place. At the same time, like if you don't decide to sell, you've kind of, you've hired somebody to kind of move yourself out of the business. If you kind of want to go that route and just be this profitable entity that just sort of, and you don't have to do much work, or you go work on something else, it's probably good either way to have someone like that in place.
Yeah.
Hard to find that person though.
Yeah.
Yeah, I was gonna ask, like, kind of on that same path, how you all think, like, you're just launching Big Band, like we kind of, like that just happened, right? The announcement was like a couple weeks ago, if I'm not mistaken. So congrats, that's awesome. And Thank you. The site looks great. I was telling you before we hit record, like the site looks awesome. I would check out for anyone who's listening, go check out, it's bigbandsoftware.com. And the video is really nice, like overview kind of like how you all think about business and how it definitely feels different from a lot of the stuff you see and hear out there. But how do you guys think about like talking about, when you see someone with a potential teammate who could potentially become the leader of that company, like, makes me think about like, how do you see in general when you're looking at opportunities, how are you thinking about that transition for like the founders and also for the team?
Yeah, the key things that for us that are maybe a little bit different from how others would approach it. We are a holding company, so in theory, there's a big complex structure up above. But we do want every business to really have somebody who acts as CEO. So and it's not just a title; it's sort of a level of power and ambition and autonomy for that business that we think is really important. So we're going to be very decentralized in our operations as we close on businesses. At the holdco level, it's really going to be mostly sort of a little bit of help at finance and accounting usually, and otherwise the teams running the businesses, including the CEO and others, are really going to make the right decisions, with sort of input from us on what the plan's going to be, but and everything running different versions of a profitable growth model. For that team, that it really is a decentralized model with a lot of power to figure out the right way forward. And I underline that because, look, Kevin, Jason, and I have been active in the space for a long time. We've done a lot of deals, and one of the key learnings there is that even the very, very best products, best companies, once a sale happens, if there's not someone who's kind of waking up in the morning thinking about the vision for what's next for that business and that product, eventually growth tails off and customers aren't as happy. So as much as we are absolutely buying businesses where the founder has had the right vision, there has to be a team engaged and feeling like they have the power to decide what that next second vision is going to be. So there's still a lot of entrepreneurship left to be done. Once the transaction happens, it closes. We often are replacing the founder and bringing in or elevating a new CEO. So the other thing I'd note is that with this model, we do have the capability to keep founders involved at an advisory level for the long term. So, yet to play out the details of that, but we do think it's really the best of both worlds. You got a new team with new energy thinking about what's next, but we want to obviously, if the founder is interested, there's options for them to stay involved at the board level.
That's awesome. Yeah. Cause that's something we think about or like talk about a lot too people who have made deliberate design decisions with their companies to be like, to work for them and to give them optionality and stuff. Sometimes I think that it doesn't feel as much. I've never done the venture route, so I don't know what it would feel like, but I could imagine if you burn yourself out for a few years, you might just be like, just get this thing out of my face. Whereas maybe you keep it on your LinkedIn, so you stay as an advisor. But for the smaller end, it's like, I could see that there's so much kind of built up context and like, so honestly, kind of like love or a feeling of attachment. So I think it's cool to at least have the option to kind of like stay around a little bit.
I mean, we always have, even with user feed, we're always like, I don't know. Like we actually still have people reaching out to us, like on LinkedIn and stuff. Like I guess they're like new customers of UserFeed, and they'll reach out to us with questions or whatever. Like we're not involved anymore. It's like not even on our. I don't know, but it does. But I'll literally help people. Like I'll be like, actually, yeah, you do X, Y, and Z. Here's the art. I do support.
It's hard to untrain that part of it.
Yeah. Well, it's like if I know the answer, I'm probably gonna give it to you, even though it is gonna take 5 minutes of my time that I probably shouldn't give to it. But I just like, it's something about the fact that it like, I don't know. It's like, even though you're not running it anymore, you still built it. And so it's still like, it's still a part of your sort of like reputation, I guess, as like a software entrepreneur. So I don't know, like if there's UserFeed users out there and you want support, just come to me. I'll give you the support. I'll keep giving you support.
I've got this vision of like 400 Twitter DMs for you later today.
Yeah, maybe not that much.
It is that space is pretty busy though, so be careful what you wish for, Landon.
Yeah, that's true. Well, on the hiring side, you said that you typically will try to hire like a new CEO. Maybe I assume you probably hire additional folks for these businesses. How do you go about hiring for these? It's kind of a weird scenario, right? It's like, it's a business that already has like traction, like significant traction if they're over $1 million. And then you've got to find someone that fits in right at that specific time. So maybe they're not like the type of people that are, more, I don't know, like grinders, like getting it off the ground from nothing. But like, so what are you looking for when you hire folks, and how, I mean, for anyone that is looking for something, like how would people find that on your end? Like where would they go to look for jobs on
basically Landon's trying to hire all these people before you get them, so.
I mean, I might be looking for a job soon. I don't know.
Yeah. So we are throwing a wide net for talent, trying to make those connections. So I'm kind of leading the charge on the buying side of things. Also working with Kevin and Jason, obviously. But Kevin and Jason, they're spending a lot of time meeting with potential CEOs. Kevin in particular is leading the charge on talent, and we're lucky enough, in case it wasn't clear, like we have cash in the bank from our investors, and those investors also are pretty sophisticated in how they think about talent, and we're getting help from them, both in terms of who they know and how they think about a process. So Parker Gale and Talisman. Parker Gale's a software focused private equity firm out of Chicago that is involved in a lot of bigger software businesses. And Talisman's a long-term focused private investor out of Ohio, and both of them, like us, we're totally aligned. Like we can make the best possible buying decisions, and if we don't get the right team in place to help for what's next, like it's not going to work out very well. It's not going to be fun for that team. So we think focusing on that next leader, particularly when the founder's fully exiting, which is our model is 100% acquisition, is really important. So, go to our website. We've actually had a lot of inbound on the talent side in the last few weeks. It's really exciting. So we are being super methodical about tracking all potential candidates in our CRM from day one, from launch day, and it is going to be a big effort in terms of who's going to line up. It's a longer conversation on the sort of full hiring process. But what I can say is like the right hires, particularly to lead businesses, is going to be a combination of outstanding, ambitious, talented people. Don't really care whether they're what their educational background looks like or whatever. Like but they're going to have shown either from their work, their track record, like they're ready to lead a business, particularly a software business. They're steeped in it, and there has to be some particular fit with the business. So it can be kind of hard, right? Like, you both obviously you've got plenty of chops from leading and building, and if I handed you the option to be CEO of an enterprise SaaS company selling to, I don't know, selling to the ag industry, right? Yeah, I was gonna go. I was like, I don't know anything. I don't know. Do you know Do you know anything about ag software?
I used to run, yeah.
you
used
want
to
the
run
job?
a farm. Yeah.
So there's some of that it's hard. We want to find that next formula for the kind of the magic in terms of who the leader is and who the customers are, right? And because ultimately the leader of the business is the one sort of negotiating and prioritizing every day on how the team is meeting the customers where they're at and providing a little bit more value for what their needs are.
It gets me thinking, like, obviously there's a lot of variables for you all and factors. But I'm curious, like, do you have targets, or like if you could acquire, your ideal number of businesses in a year, is there one, or is it sort of more complicated than that?
Yeah, I think ideally we'd like to be buying, at least closing at least once a quarter. But we also it's always but they have to be the right businesses, right? So
sure.
If we run into 4 of those right businesses next quarter, we will figure it out, right? And that's one of the things I'm really happy about we're fully funded and we've got a larger team sort of behind us and supporting, so we can pull in talent as needed. But at least one a quarter is what we're hoping for. Even faster would be great. Typical transaction sizes, just so that your listeners know, like most deals for us are going to be in the $3 to $15 million enterprise value range. With I'd say a real sweet spot in that $5 to $10 million enterprise value range. And we can go a little bit bigger. We can go around 20 for the right deal, but most of our closings are going to be, in that spot.
Nice. Yeah. Yeah. I was thinking about it because I'm like, if you said you're getting talent inbounds, which is awesome, by the way. I'm thinking like, I would assume that's almost never the limiting factor, probably. I would guess like the actual finding and vetting the companies is probably a bit harder. But like you said, there are cases where it's like these businesses are pretty in weird pockets of the world that you kind of need a certain fit of a founder or CEO to come in and run it. So like, how do you think about balance? I know you mentioned you're more on the buy side, but it's like, how do you balance like accumulating this sort of CRM of potential candidates, and then you're like, we don't really have any gigs, and kind of we'll be in touch, or like, how many do you even think you need to have if you're trying to acquire, let's say, 4 or 5 companies a year?
Yeah, we'll do more work on that sort of people pipeline as something gets later in our deal pipeline. So we're generally, we love those connections. I mean, it's super energizing for all of us to talk to folks who, would be interested in having a role in one of our businesses. And it's easy enough to track those and be aware of like particular skill sets, particular strengths, and to be able to hopefully call on them in the future if something in the portfolio is going to have that need. But as a deal, if we know a closing is going to happen in 6 weeks, well, obviously then we're spending a lot of time on talent for that business. And it's not to say that there's not great talent already in that business. As I said, like it's fantastic. If we don't need to do any hiring and it's going to be about elevating and supporting and coaching some folks who are already involved, fantastic. But if more is needed or could be helpful, then we'll be spending a lot of time on the hiring funnel.
All right. I wanted to break away real quick just to talk about our sponsor for the week, Fetch. And it's fetchtruck.com. So this is a really cool product that I've used, that my neighbor uses all the time. And it's, that challenge you run into where you have something big that you just purchased or something really big that you have to move and you have no way to move it because it's impossible to pick up and carry somewhere, or you don't have a truck or some sort of larger vehicle that you can, move that stuff. And so Fetch makes it really easy for you to just go to their site or go to their app and find a truck or van on demand. And they have all different types of trucks that you can, different vehicle sizes that, depending on what you're moving. It just makes it really easy to be able to access that when you need it. But the real thing that I wanted to focus on that's really interesting to me as an entrepreneur is their partnership program. So if you have, a truck or some sort of van that you already own, or you're thinking about, maybe you're going to buy one, they have this really cool program where you can basically rent out your truck, rent out your van, and you don't have to do any work. You basically just sit there. They do all the marketing. They put the insurance on the cars, and obviously they have the marketplace for folks to find you. So they basically do all the work, and you just sit there and rake in cash. So while you hear all these podcasts out there and all these different creators and entrepreneurs talking about, buying a house and renting out, for Airbnb and things like that, and that's how they make passive income, that's great, and those are cool ways to make income. But sometimes they're not super practical, especially if maybe you don't have the money to kind of put a down payment on a home. And Fetch really makes it kind of, your barrier to entry is a little bit lower, which I think is really cool. And, I love that they do all the work for you essentially. So this is just a great way to kind of, get a business off the ground. And, maybe it's not something you focus on full time. Maybe it's just a part-time thing, but, being able to make up to $30,000 per year renting out your truck or your van is pretty insane. And so they have a ton of great resources on how you can do this, a full kind of partner program guide as well. If you go to fetchtruck.com, and they have a little link at the top that says list your truck, that's where you can find it. If you have any other questions about this, they are super helpful. So you can reach out to them on their site. And again, that's fetchtruck.com, and it's list your truck. So definitely check them out. And at a very minimum, the next time you have to move something large or you have to pick something up, definitely go to the site and give it a try. All right, back to the show. Yeah, so I wanted to dive into one thing that I'm very interested in. I think a lot of people would be interested in. You guys have seen and do see a lot of different companies coming through. What sort of like niches are you seeing? I guess in more of like a generalized view, or you could go more specific. What are you seeing that's like kind of surprising in terms of like, wow, these companies in this niche are like crushing it. Like what in the world is going on here? And then, on the other side of things, wow, I thought these companies would have been doing better, but they're not, this area, like, it seems like people are kind of struggling.
It does seem like they're, early in 23, right? Who your customers are is more important than it's been the last few years. Like whether it's, you sort of think about the world of SaaS, you've got B2C, you've got kind of B to SMB, and then you've got kind of pure B2B that's more bigger customers on the other side. We are focused more on the bigger side of things, pure B2B, and what's going on with those customers is really important. And like the B to SMB market, I think is churn is up in a lot of those businesses, but also for everybody, I think people have spent a lot of money on software the last few years, and those sort of, even at the B2B level, word is coming down that there is going to be some cost cutting, and if your software is not key to the business, there is some risk on retention. I'd say the most surprising thing to me, I say surprising, but I've been around the tech world. I've seen a few of these cycles. Like the hard thing right now, in case founders haven't seen it before, the hardest thing right now is, it's not that more people are saying no, you're trying to grow the business. It's just the decision cycles are getting longer, and you've got to be really smart about how you are selling. If you're selling B2B SaaS, like who's in the room, how are you selling, how are you positioning, gets really, really important when there's not a tailwind of sort of growth in software spending. And you might have to get more pointed about how the customer is going to save money. That might be need to be a 2 years ago is more about growth, and now you've got to really lay it out. Like this is why our product helps with whatever efficiency efficiency efforts that are going on at the company.
Yeah. And, like obviously I would say a lot of B2B, I mean, unless you're in like really in the niches, a lot of B2B SaaS companies are selling to other B2B SaaS companies. And so they've probably done a lot of layoffs. So it's like, what jobs are gone now that you can come in with the software and like at a much cheaper price than what they were paying for people can like kind of like, maybe 80% solve like whatever they were doing before. I think that does help a little bit, but I agree. I think that's one of the big things that at least I've seen on my end is just like the sales, everything is like way slower. It's not that you don't have like interest or that you get on a demo and you have a lot of interest, but it's just like, there's certain deals we used to close in like a week. It's like, okay, this solves my problem. Done. Like subscribe. Now there's, or we got to take this up the ladder to this person and to this person. And even I would say for a lot of times those types of things would always happen for like larger deals. So like when you get into like, high 5-figure and then like 6-figure deals, they're going to have to go up the ladder for those kind of things. But it's like the smaller deals now that seem to have to go up the ladder, which is weird. And not something I've experienced like ever in my anytime selling anything in the last like 7 to 8 years. Once something's under like $1,000 a month, you typically don't have to, like a lot of times don't have to go up the ladder for that stuff. But yeah, stuff's just like dragging. And I think that's the struggle for a lot of the companies out there in the SaaS world. But we to your point, having a product that people like, you want to have a product that's like really sticky with a company and that actually is important to them. What we've seen is because we sell to a certain type of buyer, but like we go across like SMB all the way up to like what I would consider probably like low level enterprise. So like we have a large range of like size of company, but it's like kind of the same types of companies, if that makes sense, same industry. On the SMB side, we've had multiple companies like go out of business basically. And like, that's how we're losing customers. So it's like, It's one of those things where like, it has nothing to do with your product in terms of like whether it's valuable. It's just that, and they'll literally say like, it is super valuable, but like we have no customers now. So we're we're shutting it down.
It's so painful. It's so painful when that happens. And
I know.
Yeah. Our term for that is native churn. Like, it's just part of selling to the customers that you sell for. And, those folks, like I'm guessing if there might be ad agencies, right? Like they might pop up a new agency in 6 months and then they're going to be a customer again. But in the meantime, right, churn is churn. And I know it's really hard when that pops.
Yeah, we had that happen in, we kind of have gone through this cycle, I guess. It all feels like the same cycle, but basically in like 2020, like overnight, in March of 2020, we lost, in that month, I think we lost like 15% of our revenue, like, because everybody froze their ad budgets and it just like totally blew up the system. And so, but a lot of those companies that either, that like basically churned or paused or whatever you want to call it, a lot of them came back, like ended up coming back like 8 months later. Like they started to get customers again and like they came back. So yeah, I think in the agency world, that's kind of how it happens. But yeah, it's certainly wild times for sure. So yeah, I wanted to jump into we talked about this yesterday, but the section 174 stuff, because I think it's also relevant.
People are going to be so glad that they stayed tuned for the tax update.
I mean, that might be our
like, wow.
That
I'm
might
glad
the sizzle reel.
I listened.
Let's go.
Like, let's go.
Well, and it's also like a super depressing tax update, so it's like
it's doubly boring. Yeah.
So actually, what's interesting is as this happens, two things have happened today that weren't around yesterday. One, the Wall Street Journal just published an article on this exact issue, so it's getting some national attention. And we didn't really mention it, but this is Section 174 of the tax code, which basically makes it so that all software development costs have to be capitalized over either 5 or 15 years, depending on if it's domestic or foreign like expenses. So pretty terrible. But yeah, so Wall Street Journal wrote an article this morning. I've read most of it, but my kids were running around and I had to go do that. So, and then apparently they just put up a new bill for repealing it today. I have not read that, but somebody, my kids keep, I think they're getting in the way of that. But yeah, apparently there's a new bill on the table and there's some national attention, and maybe those are like coinciding. I'm not sure. Although from what I read in the article, it didn't mention this bill at all. But yeah, so I mean, for those of you that like just kind of walking through what I just mentioned about Section 174, it basically means that like in my eyes, it's sort of the way I look at it is like you're getting taxed on your revenue before expenses almost for a software business, because a lot of our expenses are building software. They're software costs. So like it almost feels like we're getting taxed on revenue before expenses, which is literally insane. And everybody's bills are going to be astronomically higher. I think ours is like around like 400% higher or something like that. So yeah, how are you guys, like, are you hearing that from companies you're talking to? How's that affecting you, and what are your thoughts on that?
We have heard it a little bit. It's not, we haven't closed on anything yet, so it doesn't impact our operations, but it's something that's like on our radar to talk with our, accountants on how we'd handle it. Just to bring it home with an example of why, I agree. If it's not changed, this is hugely negative for independent software founders, or even just growth software businesses generally. Like, easy math. It's very easy to imagine $1 million in ARR software business growing nicely because it's investing in development, among other things, and maybe it's break even on a cash basis. But with this new law, suddenly you're like, okay, well, $1 million in ARR, it's growing great. Life is good. We're investing for the future. It's cash flow break even. But with this new law, that same business could suddenly have a pretty big tax bill, because all of the, let's say $600K of that was being spent on development, going to, the team that are developers. Suddenly that $600K would not be an expense this year for tax purposes. You'd have to spread it out over multiple years. So even though your cash flow break even, you would owe a tax bill as if you were, my math, I'm not good enough at math on the spot, but let's say, you'd owe tax on, say, almost $500K of profit that first year with the change. Like, that's potentially lethal. Right, to a software business. What's that?
You didn't know that that's what you were going to owe, because I would like, that's the big problem too, is that like so many entrepreneurs like still have no idea about this. We had no idea about it till probably 3 weeks ago. I think accountants either they don't know about it, or they kind of knew about it, but they assumed that this would be worked out, and so that nobody's been like, I think a lot of people just didn't plan for this. And so when you don't plan for something, you don't do tax planning on something, and all of a sudden you go from zero, to $500,000. You're basically like, okay, I got to go like take out a loan to pay this. And now you can't get loans at the bank because bank runs and all that jazz. So there's all kinds of issues here. There's all kinds of issues.
Yeah. So, I mean, my hope, I'm glad to hear that was in the Wall Street Journal. Like, my hope, occasionally something like this pops up in public policy and it's like, surely this doesn't make any sense. Surely it will change. Right. And that's my hope here. But to that point, like if anybody has political sway, which I don't, this is a great time to make folks aware of it, because it's not just that it's bad for the entrepreneurs. It doesn't really make business sense. It's I suppose I could see for a really big software company why they would be saying, well, you can't expense it, but it still seems like a stretch, honestly. Like, it's hard to know when you're spending money on software development what actually has long-term value and what is going to be an expense, right? And that's part of the fun of building a company and a software company, and that's part of the power. But to suddenly have to have this change go through, and potentially a lot of small businesses have to pay tax on profit that is not cash profit, doesn't make sense. So get the word out.
Yeah, I mean, it's crazy. I mean, I feel like we are pretty conservative, so it's like we're able to like survive it. But I can imagine, even if you're like running a little closer to the metal, so to speak, like a little closer to break even, like it just, you feel like you're not, you feel like you have a cushion, and this just blows it out of the water. And it adds like on a more mundane note, it adds like some burden on the bookkeeping side to like, even if you can kind of find ways to reduce that number, you have to now track that separately. So like before we're just like, we pay these people X amount, that's the money, that's the, payroll expense. Now it's like, okay, how much of the time was spent doing this specific job versus that job? And it's just another hassle there too.
Yeah. Another thing that's weird is that for the, on the if these are domestic expenses, then it's 5 years amortized. If it's foreign, it's 15 years. It's really like 16 years actually, and that doesn't make any sense to me. That it's like, wait, are you saying like the software built overseas is better than the US, like US built software or something? Like, I don't understand where that even came from in terms of like making that different, but yeah, it's nuts. The one thing I did like about what I read so far in the Wall Street Journal article is that, I think tech sort of like spent a lot of political capital in the last couple of weeks in terms of trying to get that dealt with. But it was a lot of like the VC, like the people that were spending the capital were like the big name VCs and stuff, which I would say don't have much goodwill from most of America. And so like not only they don't have goodwill already, and then we just spent a bunch of like political capital on that. And so like, oh, what's going to happen here? Because it's like, oh, tech's complaining again about something. They, like screw them. But I think what's good about because really who this hurts is, again, like small independent SaaS companies or software companies, not even just software, but like, I guess like life sciences type companies, like all those types of companies. One of the things that the Wall Street Journal article did a good job of is they highlighted like tons of different stories, and they're all small businesses doing, under, I would say like $5 million in revenue. And it was across a bunch. It was like software businesses. It was, one of them was like a data visualization business. Another one was a life sciences sort of business. Another one was like manufacturing, which I guess that comes into play too, because you're doing like, I don't know, you're doing development of something. It's different. Mm-hmm. It's physical things, but it affects so many other, not just software companies, but it affects a ton of different companies, and small, it affects the small companies the worst. So hopefully, hopefully this gets changed soon, because if it doesn't, obviously the bill that you have coming in 2022 is terrible. But you have to start doing like tax planning for the future. And what are people going to do? The incentive is to not have more development costs, right? Like, so you're just probably not going to hire as many people on the dev side, whereas in in normal times, like you probably would. And so that has very clear, like negative, ramifications across like the innovation sector. So I don't know how this ever passed, but yeah, it needs to get repealed quickly, or there's going to be like some major like long-term damage that we just won't be able to make up, and other countries are going to pass us. I mean, Kyle and I are like, Kyle's moving to Portugal in like a month for at least for a few months or something. Just vacationing, I would say, maybe. Yeah, but it's come up that we're like, should we incorporate in a different country? Like, normally that never even would have been a question, and still, like, obviously we don't want to do that, but you have to start like pulling in all the options at some point, because you're like, this is it's so damaging to a company like ours that it's just like, we gotta like figure. we're going to try our best to like figure out ways around it and like how we can, survive through it and avoid it or whatever we have to do. If we have to leave the country, start the company in a different country, like that's what we got to do. And I don't think that's what the government wants happening to small innovative, like software business or any small business. So I think they need to move on this, or there's going to be some major ramifications. But
no, I can't imagine that anybody really wants this. And for what it's worth, just from a pure business perspective, in case, when we buy a business, it's not uncommon, we might see a first income statement. Sometimes the first P&L, it might capitalize development costs. We're like, no, like this is not helpful to us. Like we need to see the P&L without anything capitalized because we're focused on cash flow. That's how we, not that we're milking the companies, but we're trying to figure out how actually profitable they are, not what the piece of paper says. So, it's not uncommon for us to say, no, like we need a P&L that doesn't have anything capitalized because otherwise, we're not really understanding how the business is working today and how the pieces are fitting together.
Right.
So, hopefully, the world will come back to that as the standard.
Yeah, that loops back to the like prepping. How do you build your company to sell? Now it's like maintain 2 sets of books. Not really, but hopefully, it'll just be simple again, and we can stop worrying about it.
Yeah.
Well, we'll keep. I guess I'll keep yelling and screaming, and probably no one listening. But I'm trying to do my best. Like I've already hit up our congresswoman. I've signed 1 million petitions. I'm tweeting about it, which is getting some pretty good engagement.
Have you put GTP4 on it already?
Yeah, there we go. We should just do like bots.
That's a good idea. Yeah, we should.
If the listenership would just sick GTP4 on it, maybe this problem would be solved.
Let's do a Twitter handle like overturn 174 on Twitter and just let's go.
Chris, thanks so much for jumping on. This was really helpful, and I mean, just us like learning more about some of the things around trying to kind of like get the company in good shape. Regardless, I think it's a good exercise for everybody to try to like get their company in a good position, whether you're selling or not. It's probably a good time to do that in 2023. So
totally, yeah. I think just to bring it home, as I think you and I were talking another time, and there's a lot about selling a business that's a little bit akin to selling a house, and you don't want to go to sell your house and then be like, oh yeah, we should really redo the lawn, and we should now's the time to spiff up the bathrooms or whatever. Like, if there are things that a new buyer would value, some sort of cleanup and organization, and it'll probably make the founder's life easier too, even if they don't want to sell.
Mm-hmm. I mean, at a minimum, people, like, I know in the early days we really skimped on like books and stuff. Like I think at first we were like doing it ourselves. That was a terrible idea. And then we kind of like, we just went as like cheap a route as we could because we were bootstrapped and we basically were making no money. But in hindsight, starting new things now, we're very, because we started a couple of new things and we're like very particular about like, keeping the books, number one, but also like keeping businesses separate, because that's something we've always, we've built other things before, but we like kept them under the same entity. And then you start to run into like, okay, well, what expenses are part of this business versus this business? Like, if there's like 2 tips I could give people, it's like keep books from the very beginning and keep everything separate. If they're different like assets or, whether it's companies, assets, whatever, like keep it as separate as possible, separate bank accounts, separate, credit cards, like everything. And you'll probably be in at least a decent position, moving forward. But yeah, again, thank you so much for jumping on. This was awesome, and it's always good to talk to you. So I guess the last thing would be, where can people connect with you?
Yeah, please do reach out. I'm on Twitter at CW Reedy. Come at me through our website. I get any email that comes through our website, as do Kevin and Jason. So folks have interest, give us a shout. Also, I guess it doesn't age me too much now to say this. Also, I do actually read my LinkedIn direct messages. So I hope I didn't do personal damage to my brand there, but happy to have a conversation with founders. Absolutely, anytime. Like I as much as I said, like there's a lot of this is about thinking about selling someday. I think most founders, they should have a short list of folks who are like, okay, like I've talked to them and I understand their perspective. And even if you end up selling to them directly, great. If you end up going through an intermediary, great. But I think, happy to have those introductory conversations and make a little bit of a connection, hopefully provide some value, even if we don't buy the business. Hope folks will reach out if they have more interest in what we're doing at Big Band.
Awesome. And are you going to MicroConf?
I am not. Jason is.
Okay.
Then I think we'll be at SaaS Stock. We do have a fantastic partnership with Dan Martell, and we're going to be involved in some of his events for SaaS Academy. So we're going to be there, and then later in the year, I think we've got even more travel. So you should see us out and about. So hope some folks might reach out to me when we're down in Austin for SaaS Stock.
Awesome. All right. Well, thanks for jumping on, and I think we're done.
Okay. Awesome. Thanks so much.
Awesome. Yeah. Thanks,
Appreciate
Chris.
it. Take care, Kyle.